Hi, guys. This is Tim Melvin of the Tim Melvin Deep Value Report in the Banking on Profits newsletter, coming to you from down here in Central Florida on what is the middle of a stretch of just absolutely gorgeous high 70s, low humidity weather. Really having a good time down here right now, except for the despair that's kind of hanging over the household since last week. Uh, Second week of Grapefruit League minor league ball down here. The Baltimore Orioles have not won a game, been blown out of a couple of games, as a matter of fact. Now, you attribute that to that you've got single A and double A pitchers that are not ever going to see the Major League Baseball mound, and some guys that nobody will ever hear of again at the positions late in the game. But there are some concerns about the pitching coming in. Ubaldo Jimenez was horrible in his first outing, much better in his second outing yesterday, and there have been some good signs. Both Dylan Bundy and Kevin Gossman have pitched well early this year, but as I checked the calendar here before we came on, we're losing right now in the sixth over in Sarasota to the dreaded damn Boston Red Sox. I hate to lose to them no matter what the circumstances. So hopefully Buck and the boys get their act together. Not time to panic. A check of the standings shows me that the Chicago Cubs, one of the best teams in baseball this year, also only has one win in Cactus League play. The Orioles don't have a win, but we do have a tie. That's the game that I was at against Atlanta. Been a strong week for the stock market. We just continued to move higher. A little profit taking today, but coming into today, we were up 3.74% as measured by the S&P 500 over the last week. Now, no real reason for this. You certainly have had a nice bounce in oil that has driven some oil stocks higher, some of them dramatically, even stupidly so higher. We saw that in our portfolio last week with some of our battered names going up 50, 60% just in last week's trading activity. Slowed down a little bit this week, seeing some profit taking coming into it. But, if the oil prices continue to move higher, so will some of these beaten up oil stocks. And it has actually led our portfolio for the first time in 2016 into the black, so we're not going to complain about that by any stretch of the imagination. Value's coming back into vogue a little bit on Wall Street, and it's starting to show up in the performance of the deep value portfolio at long last, so we're pretty excited about that. Let's see. OPEC, of course, is going to be a chief driver on oil prices, and it's getting a little contentious over there. We got a meeting coming up on the 20th of March. Nigerian oil minister said everything's going to be back on the table. No idea what he means by that, but Nigeria is one of the countries that desperately wants to see higher oil prices. The Saudis are going to have a harder and harder time holding OPEC together on, just free-for-all production levels and trying to maintain market share. At some point, just about everybody else besides the Saudis and the Emirates want to see higher prices, and you can bet that Iran and Russia are really going to be leaning on their buddies over there in Saudi Arabia to let's bring some production cuts in and get prices up, get some cash flows into our nation's coffers, because frankly, we really need the money right now. So it should be a very interesting meeting. If in fact they agree to some production cuts, you could see a sharp move higher in oil prices, and vice versa, by the way. Now, everybody got excited about the jobs report last week. Boy, I sure didn't see it. I get that, we added some jobs and the headline number looked really good, but as you drill down in there, these were, restaurant jobs. They were bartenders. They were healthcare services. And I don't mean doctors and nurses, folks. I mean aides and technicians, which are not bad jobs, but they're not real high paying jobs either. Most of the job creation was really on the low end of the pay scale. Once again, you have a very troubling U6 rate, still at 10%, and the labor force participation rate is still flirting with historic lows. And again, you have slight declines in hours worked and wages. So not a disaster, not great, certainly not worth all the excitement we heard when everybody saw the headline on Friday morning. Certainly doesn't tell us that the economy is in full-on recovery mode. As I watch everybody talk about the economy these days, I'm a little puzzled because it's like being a Republican or a Democrat these days. You've either got to be way over here to the right or way over here to the left. So everybody is saying, look, either the economy is great and it's wonderful and low interest rates and everything's going to be great and look at this unemployment number, or they're over here on the other side saying, oh my God, we're on the verge of the great global depression. It's horrible. All these jobs are just horrible, stinky jobs, and the government's lying, and it's worse in Europe, and the Chinese lie. Well, that's true. I got to kind of give them that point. But point being, you're either wildly bullish or wildly bearish on the U.S. economy. And the truth is actually back in the middle. I've been saying the same thing for almost 5 years now. I should be getting an award for some of these really fancy, economic societies because we've been spot on for over 5 years now. The economy's better than it was, but it's not really very great. We're just kind of muddling along at, very low growth rates. We've got some job creation, but there's nothing going on out there that's going to create the kind of demand that will give us a really strong economy. As Sam Zell pointed out, and I'm in full agreement with this, it's just really hard to look around the world and see where the strong demand for greater than, say, 2.25% annual GDP growth is really going to come from. It's just not there. There's no breakthrough technologies on the table right now that are going to lead to massive productivity increases anytime soon. It's probably not going to come out of China for an extended period of time. Europe's 2 to 3 years behind the United States, so they still haven't gotten up to muddling through yet. So it's not horrible. I don't think we're going into a global, recession or depression, but it's not very good, and it's going to take a while for anything to happen in the economy to stir up and create some demand. Which brings us, of course, to the presidential elections, which so far have really only increased demand for puke bags across the United States. This has been the worst election I have ever watched in my life, and I've been watching these things since I was a kid. I think the Nixon election was the first Nixon election was the first time where I really got interested in politics. I was a weird kid, okay? Watching the conventions and the speeches and the drama as it all played out, and I became hooked. I watched conventions and State of the Unions and election returns like other people watch football games. But this year, this is just horrible. I don't really see anybody on either stage that I would be confident with as president. I'm frankly puzzled and intrigued, and to the point where I'm going to try to get them both on the phone. I've tried before with very little success, but I really want to know what's driving the endorsement of Trump by Tom Barrack of Colony Capital, one of the smartest real estate investors ever, and Andy Beal, who just take out any qualifiers, he's one of the best investors ever, fantastic businessman and mathematician. Is it just to shake things up, go in another direction? I could actually support that because what we have now from the Republicans and the Democrats is not working very well for us at all as a country. So we shall see. Anyway, today in our portfolio, the Banking on Profit subscribers, we throw out what's called bonus picks, and these are stocks that we can't put them in the portfolio. They're too small. Okay, so some of our subscribers will be able to buy it around the current price. Some will not. So it's really not fair to put it in the portfolio and say everybody's got it because it's not going to happen that way. Plus, sometimes our own buying will create a temporary upwards distortion in the price of the stock, and that's going to make our performance look better than it really is. Our performance is just fine. We don't need any performance enhancing stock recommendations, okay? So we call them bonus picks and we send them out. And one last year, right about this time, I think it was in June, if it was a little later in the year, was a mutual thrift that had just done its first step conversion. A couple of activists had a position in the stock, and one of the things they were pushing for, of course, is to do the second step. We love these investments, okay? A thrift that has just done its first stage conversion usually has a little pop, and we try to buy just right as close to that first trading day as possible. We don't have deposits in all of the thrifts, so we're not going to get the IPO shares like Peter Lynch used to, and I know some guys still do put deposits in all the remaining thrifts so that they get IPO shares. We don't have quite the cash flow to do that around Shea Melvin. So what we do, we buy that first, second, or third day of trading when there's still shares being turned over. There's adequate liquidity. We can get in there, and both our subscribers and us can usually get a position on. But again, because they're small, we only rate them as bonus picks. We try to be as fair about this as possible. Well, we had one today, And this stock has done nothing, folks, since last June. It's just flatline. If that was an EKG, they'd have declared it dead. But the bank was going on. They were taking in deposits, making loans. Book value grew a little bit. Everything was good. And today they announced that they were now going to do their second step conversion. Boom, stock's up 30% today alone. And it's going to go higher as we get close to the offering, and it will pop again, and most likely after the second offering. Let me just quickly walk you through the math of why we love first step thrift conversions so very, very much. Okay, we got a $20 million bank. I'm going to use easy numbers here, okay? Remember, small bank, so this bank has $20 million of equity. So we're going to do first step conversion. We're going to sell 1 million shares at 10, and the mutual holding company is going to hold another 1 million shares at 10, thereby owning half of the bank. Now they have 20 million equity. We just took in 10 million bucks. Okay, now we got 30 million of equity. The stock was priced at 10, popped to 12. I buy at 12. Okay, now I'm just going to sit on the stock. I'm not going to do, I'm not going to trade around it. Well, couldn't trade around it if I wanted to, because after the first week, liquidity is leaving the building. It's going to be hard to trade this thing. So we're just going to sit there. We're going to go about our banking business. We own it at 12. Stated book value, by the way, looks like, right, 2 million shares outstanding. The MHC has 1 million. We have 1 million. 30 million assets. That's $15. Except it's not. Okay, the real book value in this deal is $30 million. That or $30 a share. That 1 million shares that the MHC owns, that's basically just treasury stock. The only thing they can do with it is sell it in a second step conversion. Beyond that, it goes no further. All the other assets are actually owned by those million shareholders that own the 1 million shares that they purchased at 10. Stumbling through this, but you get the idea. So now, we own 1 million, stocks at 12, book value stated is 15, reality is 30. Year or two goes by, book value goes up a little bit. We're going to do another 1 million shares. Book value grows to, let's say, $20 on paper. All right, after over 2 or 3 years. Book values are growing about 7% right now. That's not unrealistic over 3 years or so. So now we've got, we're going to do another offering. All right, we're going to sell the other 1 million in the second step conversion. So we're going to sell 1 million shares at book value of $20. So we've got a bank now we've got book value 22 million shares. It's 40 million of equity. We are now going to sell another 1 million shares at $20. So now we have a total of 60 million of equity. There's still just 2 million shares outstanding. We didn't issue any new shares. The MHC sold theirs. So we paid 12. Book value on our shares is now $30. So we go along 3 years later. This thing gets, book value continues to grow. We get sold at about 1.5 times book value. Boom. In our holding period, that's a 25% plus annualized rate of return. We've gone from 12. Stock is book value gets up to $40 a share. Let's say we sell it somewhere in the 50s, just with just the regular growth of the operating bank. They buy back some stock using the excess capital that they've taken in. Not hard to see book value grow to that point 3 to 4 years after the second step conversion is complete. So we're making 25% a year on our money, and we've done this time and time again, folks. So this is not mythology or a made-up story. We get a huge discount to the real book value on the first step conversion. The stock comes up, makes the second step announcement. It pops again. They do the actual offering. It pops again as they actually take in the new assets. And then eventually, about 75% of these things are sold 3 or 4 years down the road after that second step conversion. Eventually, we're going to sell this thing at 1.3, 1.4. I think the normal multiple right now is about 1.4 times book value. So we get book value growth from the natural operating conditions of the bank. We get additional growth from the assets that are taken in through the 2 public offerings of stock, and then we sell the whole thing at a huge premium. Process might take 6 or 7 years, but if I could sit back and earn an annualized return north of 25%, and that's how a lot of these are going to work out, I'm pretty happy with it. It's a very low risk investment because these tend to be very conservative, very well run financial institutions with very little problem loans on their books. Excuse me. Okay, coming up, we got just about a week, exactly a week actually, until the new Randy Wayne White book, Deep Blue, hits the stores. Always very excited about that. I'm very hard to find uh, for about 24 hours after that book downloads onto my Kindle because I read them pretty much as soon as they come in. So don't look for much from me next Wednesday. I'm going to be busy just as soon as I can get cracking on that book. It'll come in Tuesday. I'll get to it Tuesday evening. I'll finish it by sometime next Wednesday. So we're looking forward to it. And I just saw this. Came across my little book newswire that I like to track. On May 3rd, which also happens to be my birthday, so this is a little early. This is a birthday present for Tim. There's a new Richard Russo book coming out. And he's one of my favorite writers. If you've never read him, look him up on Amazon today. Go buy a whole bunch of his books. But this one's called Everybody's Fool, and it is a follow-up to a novel he did years ago called Nobody's Fool that was eventually made into a movie starring Paul Newman, and even Bruce Willis had a part in that picture that was not a box office success, but it was a pretty cool movie. If you've never read Nobody's Fool, it is a great book. Read the book, watch the Paul Newman movie, and then on May 3rd, you will be ready for the second edition when it finally comes out, Everybody's Fool by Richard Russo on May the 3rd of this year. I'm really excited about that one. Now, our friend Tobias Carlisle, who wrote Quantitative Value and Deep Value, has another one coming out called Concentrating Investing. He's working with a couple partners on that. It's going to be out April 26th. If it's anywhere near as good as his first two books, it is going to be a treat and educational and help you become a much better investor. So anyway, that's all I've got from down here in Central Florida. Sorry I stumbled through that mutual conversion example just a little bit, but you buy as soon as possible after the first offering. You get a pop when the second step conversion is announced. You get a pop when the second step offering is completed. At every step of the way, you're bringing in new assets that dramatically increases the book value of the stock that you've purchased. As you saw, the book value was stated at 13, in reality at 30. By the time we're done with this process, book value is $40 a share based on new capital bought in. If you get any earnings growth or stock buybacks that are done over that period of time, then you know what, book value is going to be even higher. We paid 12. It's an outrageous rate of return, and not a lot of mutual thrifts left, but when you can find them, it's one of the best investment strategies that you'll ever have an opportunity to participate in your lifetime. We cover these heavily in Banking on Profits and Banking on Profits Monthly. So if you're not a subscriber, again, you really should be. So anyway, they tell me it's warming up, getting nice weather all over the country. Kind of hate to hear that. I'm not going to be able to tease my daughter in Chicago as much, although it's Chicago, so I'm sure it'll get cold again. As a matter of fact, my prediction is I have to go up on the 24th, so that weekend it's going to be cold in Chicago. It's a pretty safe bet. But anyway, excited about going up there to see her and her husband. We're going to spend the weekend together. Anyway, that's all I've got down here. It's a great weekend across much of the United States. Get out there and enjoy it, and have a great week. And I'll talk to you guys next week. This is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits saying goodbye, and again, have a fantastic week.